If we go by history, September 2020 may be quite a bit different than the gung-ho market of April to August of this year. And if you're wondering, I'm not saying this is good. Historically, September tends to be a weak month for stocks. According to LPL Financial, September has been the worst performing month for markets on average since 1950. So, what could go wrong? Well, let's check your compass. As I've mentioned in previous videos, things are a little odd regarding the VIX. And as this chart shows, the oddity has gone on for more than just the past week or two. As you can see, the VIX has been trending upward since early August. And this is odd since the markets have also been trending upward during the same time frame. Normally, this is a warning sign as it implies that professionals are buying protection to lock in gains or protect against downside if the stock market is overvalued and enters a decline. However, in the current situation, there may be another reason for the rise in the VIX. There seems to be the possibility that the VIX is skewed with retail investors. Not only are the retail investors buying up stocks and pushing the markets higher, but it appears that in order to take full advantage of the rise in stocks, retail buyers are leveraging their positions with call options. And that demand for calls has bid up the volatility and lifted the VIX. Now, I have one cautionary point. We have seen this pattern before in March 2000, right before the bust of the dot-com bubble. To be clear, this does not mean that we're going to have a collapse in the market. I just want you to know that the downside possibilities are there and to defensively prepare your portfolios. And this chart here shows much of the same information, but from a slightly different perspective. And as I've said recently, the VIX is very stubborn. It doesn't want to go below that level of 20. And so you can see here that as the S&P 500 hits all-time highs, the level of the VIX remains unusually high also. The VIX is at a level that has not been seen since the extreme speculative days where retail day traders were trying this out in about March of 2000 near the market highs. And we know how well that worked out. And so to sum things up, as you look at this chart here from advisor perspectives, and it's a variant of the Buffett indicator using the Wilshire 5000, we need to remember, number one, valuations have never been this extreme, and that means never, ever. Number two, the VIX correlation to stocks is at its highest since Volmageddon of 2018, and we know what happened after that. And lastly, number three, the VIX and stocks are showing patterns of extreme speculation that are similar to what occurred near the peak of the dot-com bubble. And so hopefully those experiences served you well. And by now, you should know my advice. Be prudent. And for today, that's ChewDog Charts. Thank you.